Hi there, welcome to kneppyinvests. I do have quite a few watch lists, and the companies I decided to put on the watch lists are there for many reasons. And one of my watch lists is an IPO watch list. In fact, I have about 100 companies on that watch list that have IPO'd over the past few years. And all I want to see is how the company performs as a publicly listed company. So every time there is a new listing, I will have a quick look at that company, and based off what they do, I will either discard them and not look at them again, maybe forever, or put them onto one of my watch lists. That's definitely true for the company I'll be featuring in this video, and that company is Limeade. When they listed on the ASX towards the end of 2019, I just saw what they did. They're like a SaaS company with annual recurring revenue. And I am attracted to those sort of companies because of the scalability, operating leverage they can have, in particular if they are increasing their annual recurring revenue. That's a very important point. They have to be increasing their annual recurring revenue. But over the past 2 years since Limeade did list on the ASX, this company has underperformed both financially and valuation or share price wise. In fact, the share price has fallen from well over $2 to a current share price of about 50 to 60 cents. And the big question that raises is whether Limeade right now is great value or it could be a value trap. Because when you do look at some of the valuation metrics in regards to this company, it could be attractive, but maybe the market is seeing the problems this company is facing, and that's why the share price has fallen to where it is now. And that's the big question I have to ask myself. And I think other investors should ask themselves that question as well. Now, the management have come out and they're a little bit more bullish about the future, but I do think we're going to see a lot of players within the market be less trusting in this management team just because of the problems this company has gone through over the past 2 years. And that also introduces some more possibilities because the lack of trust in management, and if management can grow this company over the next year, that trust will build, and that will mean the share price will increase as well. So you might have an increase in share price because of a building trust in the management team and growing financials. And I'll just talk about those valuation metrics and why it's looking attractive now. But the question I have is whether this company can start growing, because this company has gone backwards over the past 2 years. So before we look at whether this company is great value or a value trap, just a few facts in regards to Limeade. Limeade is a software company and they're all about enhancing employee experience. And that is attractive to me because it is without doubt really important that your employees are as happy as they can be, because a happy employee is going to be more than likely a very productive employee as well. I also believe incentives are very important as well. If an employee has no incentive to perform well or hard, more than likely they'll just perform average. So I do believe incentives are important. And working in an office or working from home, the experience we have there is very important as well. And I think a lot of management teams around the world are understanding this, that the employee experience is a very important thing they should be looking at. So I can understand where Limeade is coming from in their business model, but it hasn't really worked over the past 2 years, which is surprising to me. But I do think there is potential once we go through COVID-19 and the after effects, which we are getting through right now. I think there is potential that this company will explode depending on the software. Maybe that's the problem. Maybe it's the software is the problem. That's why they're not expanding. And I'll have to dig a little bit deeper into that in the future. Limeade was founded in 2006. This is a United States-based company out of Washington State. And they listed on the ASX towards the end of 2019, just before Christmas, just before the COVID-19 financial panic. A good thing about this company is the CEO is also the founder, Henry Albrecht, and he also has 16% holding in the company. Lots of skin in the game. That is a very attractive point about this company. And two of the largest shareholders include Perennial and Australian Ethical Investments at 8.8%. The market cap right now for Limeade is not too high, $132 million at 52 cents. it has been significantly higher than that in the past. And when you look at some of the financial metrics of this company, a market cap of 132 million looks really interesting, but you have to view those financial metrics in isolation because some of those financial metrics actually are coming down. In particular, the most important financial metric, which is annual recurring revenue, that has been dropping over the past 2 years, and the ticker code of Limeade is LME. Since Limeade is a United States-based company, their financial year is identical to the calendar year. So in this slide, what I'm going to do is compare financial year 20 to financial year 19 for Limeade, just to see how the financials of this company have been progressing or were progressing over this period of time. Now, the other good way to look at this is financial year 20 was post-COVID or during the COVID-19 period, while financial year 19 was pre-COVID. And it does seem like this company was not affected by COVID-19, just looking at these numbers in isolation. But management have mentioned they were affected by COVID-19, which actually did surprise me a little bit because this company is all about enhancing employee experience. And I thought during the COVID-19 period, this would have been a very important factor for employees, but it seems like maybe it wasn't. And maybe that's why we've seen the Great Resignation become a major point in not only the United States, but also it has been filtering through the rest of the world. And the reason why the Great Resignation is important because a lot of these employees have been unsatisfied at work and they're looking for jobs that they'll be more satisfied. So it's becoming very apparent that enhancing employee experience in the workplace is very important. And that's why I do think there is potential for Limeade in the future. And we'll get to that during the rest of this video. But if we compare the performance of Limeade from financial year 19 to financial year 20, things seem to have been progressing fairly well. Revenue increased from 47 million to 57 million. Gross margins, even though I'd like that to be a little bit higher than 78%, have increased from 75%. This company is operational cash flow positive by $4 million in financial year 20. A lot of these sort of companies are not operational cash flow positive. In fact, a lot of them are operational cash flow negative by a significant amount. Just have a look at Dubba with a market cap of well over $1 billion. Sure, it has growing revenues at a significant rate, but it is operational cash flow negative by a significant amount. And the company is almost profitable, only loss-making by $300,000 in financial year 20. They also had $32 million of net cash at the end of financial year, which means the enterprise value for Limeade was $100 million. Now we get to some of the valuation metrics for this company. And this is where my interest in Limeade is enhanced, it is increased. So enterprise value to operating cash flow seems a little bit high at 26.3, but this company has operational cash flow. A lot of these sort of companies, you can't calculate the enterprise value to operating cash flow because operational cash flow is negative and operating cash flow is fairly low. But two of the most important valuation metrics for these sort of companies is the price to sales ratio and looking at the annual recurring revenue. Price to sales ratio for Limeade 2.4. A typical number for these sort of companies is 10. So this looks like it could be really good value compared to a lot of the other players in this sector or in the SaaS space. And the contracted annual recurring revenue is 55 million. Now, what I do with the annual recurring revenue is I simply multiply that by 10 to give me a rough estimation of a possible value of this type of company. So when I do that with Limeade, I get a rough estimation of the market cap or potential market cap, and that gives us 550 million. So there's something else going on here. And the next thing I usually do is I look at the growth rate in our recurring revenue. And if it's growing at a quick rate, that will justify 10 times multiplication factor for annual recurring revenue. But sometimes annual recurring revenue can be growing fairly slow. So a 10 times multiplication factor is probably too much. Maybe a 5, a 4 is better suited to that company. But with Limeade, the multiplication factor is 2 for this company. And that seems really low. but I think there is a reason behind that, and we'll talk about that reason during the rest of this video. Those financial year 20 numbers for Limeade were to the end of the calendar year 2020, which means Limeade have released their first half results in August of this year, and things have not progressed well in the first half of financial year 21. In fact, revenue has dropped from $28 million to $26.9 million. Gross margin has dropped to 76%. This company is no longer operational cash flow positive, negative by $1.4 million, and loss-making by $3.2 million. Still have net cash of about $32 million. But more importantly, the contracted and recurring revenue fell from $55 million to $52.5 million. So what I usually do by multiplying the annual recurring revenue by 10 to give me a rough estimation of the value of this sort of company, and then I adjust it based off the growth rate of annual recurring revenue. For Limeade, annual recurring revenue is not growing, it's going backwards. And that's the main reason the market is giving this company a major discount at this point in time, because annual recurring revenue, which should be growing for these type of companies, has dropped. I think one of the reasons it's dropped is because they have lost some customers. In fact, they lost a fairly big company or client, which was American Airlines, which was something like $2 million of annual recurring revenue. A slightly positive thing in their half yearly was they did reiterate full year 2021 guidance, but revenue of between 50 and 53 million, which is lower than the previous year. EBITDA negative by between 5 and 8 million, and profit loss making between 7 and 10 million. So it does look like financial year 21 for this company will be a bad year when you look at some of these financial numbers. And that's why there is a major discount to this company's value right now. The market is not liking where this company is heading. And just to reinforce how negative this company has performed in the past year, what I'm going to do is compare September 20 quarter to the most recent quarter, the September 21 quarter. And it really looks like things have gone backwards over the past year. 1 year ago, they received $23.7 million in the September quarter and were operational cash flow positive by $5.7 million. And I still remember when I saw this quarter report and I saw that operational cash flow positive by $5.7 million. It really piqued my interest in this company. And the major reason I didn't take a position in Limeade was simply because of the market reaction. The market didn't react that positively to these results. In fact, we have seen the share price fall since then. So it seems like the market is on top of how this company is performing, and they weren't seduced by this quarterly report. And because they were operational cash flow positive by a fair amount, and they weren't burning through a lot of cash in investing and financing activities, all that cash, or all that operating cash flow went to the bottom line, and they increased their cash on hand from 28.4 million to 33.5 million. Now let's have a look at the most recent quarter just to see how this company has performed over the past year, and it's not very good news for Limeade and its shareholders. As we look at September 2021 quarter for Limeade, things have not progressed very well for this company. Receipts from customers fell from 23.7 million to 16.1 million. That's a drop of, $7.6 million. And sometimes when you see receipts dropping like that, a lot of the costs will have dropped as well. But for Limeade, it's a complete opposite. So receipts have fallen, but a lot of the costs have actually increased. For instance, staff costs are up by 1 million, product manufacturing and operating costs up 400,000, and administration costs up 900,000. The only real cost that has gone down is advertising and marketing, down $60,000. So what you have with Limeade over the past year is receipts dropping, but costs increasing. Because we have those two things going, instead of being operational cash flow positive by $5 million in one quarter, Limeade was operational cash flow negative by $4 million in this quarter. They also made an acquisition and spent $8.9 million on that. And because of that acquisition, and because this company was operational cash flow negative, the amount of cash this company had fell from $28.7 million to $15.5 million. So things are not progressing well for this company. And that's why there's a lot of negative sentiment in Limeade right now. That's why the share price has fallen to almost 50 cents. So if this company's management can turn things around, this company would be really good value. And that's the main question we have is, can management turn things around? Can we start seeing receipts grow? Because if we can't, this would be a value trap. One thing I always look at for companies that do release Appendix 4Cs, even those who don't, is I look at the receipts history through time or the revenue history. And what I want is at least 8 periods of history. And we have that now for Limeade. And the other thing I'm looking for is receipts growing through time. That is one of the most important things I am looking for in an investable company. And unfortunately for Limeade, it's the complete opposite. If we look at the trend here, in fact, it is possibly going down. There is a bit of lumpiness here, but when you go back to December quarter 2019, the first quarter, they were listed on the ASX. They received $19 million in receipts. And in the most recent quarter, only $16.1 million. So one of the things I'm looking for in an investable company is simply not here for Limeade. And this is another reason why the company or the market is not in love with this company, why there's a big discount to the company's valuation, why the share price is under pressure, why everything's just going wrong for this company at this point in time. Another thing you can look at for these type of companies is just the growth in annual recurring revenue, or as Limeade calls it, contracted and recurring revenue. If we go back to 2018 into 2019, we were seeing contracted and recurring revenue growing. It grew from 36.5 million to 57.1 million in 4 quarters. So this company was looking quite attractive around the time they IPO'd onto the ASX. And that's possibly why there was a fair bit of interest in this company upon listing. But ever since they listed on the ASX, and contracted and recurring revenue has been going down. It's fallen from $57.1 million in the second half of 2019 to $52.5 million in the most recent half year. But company's management is saying they expect to return to growth in the second half of this financial year. In fact, they said new customer acceleration expected in second half. Now, this is management's expectations. And we know from the past that a lot of times when management have expectations about their future, they are not met. So I don't think the market is expecting this to become true for this company. They want proof that they are growing contracted annual recurring revenue. And if you do have the belief that what this company's management is saying is going to be true, it is going to be right, then that is or gives us an opportunity to buy this company at really attractive values. And that's the question we have to ask ourselves. Are management right in their positive outlook about the rest of this year for this company? The last thing we want to look at for Limeade is just the daily chart from when they listed on the ASX way back in December 2019. Now, they did list just before COVID-19 financial panic. So even though the share price was hovering around about $1.80 just before the panic, share price did fall all the way down to $1.20 during the COVID-19 panic. But it did recover quite well during the rest of the financial year, which was 2020. In fact, around the time they released their September quarter Appendix 4C in October last year, the one where they had $5 million of cash flow, the market did respond actually quite well in terms of share price action. In fact, the share price jumped up about 25 to 30% during 2 consecutive days, but it was on low volume. And that's telling us, because the share price jumped up on low volume, the market didn't have high conviction about that Appendix 4C. So even though it looked quite attractive, looked quite promising, there were some red flags in regards to that release. And then we saw those red flags play out over the next few months because the share price fell from a high just after the release of that Appendix 4C, which was about $2.20, all the way back to $1.44. So the market did see some negative signs in regards to this business, even though they did release a very positive quarter report. And the share price has been under pressure ever since then. Share price keeps on dropping, even though At times there have been signs of the share price turning around, but every single time we've seen the share price gone on a little bit of a run, there has been a lack of volume. And right now the share price is hovering around 50 cents, which is an all-time low for this company. And if the share price falls below 50 cents, which is a fairly weak support level, that would be a bad sign moving forward for this company. The way I'm playing Limeade is that I'm staying well out of this company, simply because lack of any positive sentiment. You definitely can't say that. In fact, negative sentiment in regards to this company, when you look at the share price, in fact, the weekly chart shows a downtrend, the daily chart shows a downtrend, and there's no signs of that downtrend coming to an end. And what I'm waiting for is a shift in sentiment, a shift in that downtrend. And hopefully, both of those shifts coincide with a positive financial report from the company. And if we get those three things happening together, that would be a powerful signal for this company. I'm just waiting for that right now. There's no reason to jump in, because all you're doing is hoping that management have turned this business around. That's all I have for this video on Limeade. The question is it great value at around 50 cents, market cap of 132 million, or enterprise value 100 million? I think it's a little bit higher now because of the decrease in cash the company has experienced in the past quarter. Or is it a value trap? What do you think? Personally, I think it's somewhere in between, closer to being great value. This could be an interesting risk-reward play, because I think the potential rewards you might experience buying it at share price of 50 cents, if management can turn things around, is probably higher than the risk involved with the company at these prices. But the problem is all about our trust in management. And even though they're saying things look like they are turning around based off their projections in our recurring revenue, that she'll start growing again, whether we can trust management. And if we are able to trust management a little bit, there could be really good value with Limeade right now. Personally, I won't be taking a position. I will want a little bit of proof, or I'd want to see some positive action come into the share price. And right now, there's no reason to build a position, because the share price is an all-time low and could keep on dropping from here on in and become even more attractive in the future. So I'd want to see some sort of positive outbreak in or breakout in the share price, a return to positive sentiment, and hopefully that positive sentiment coincides with a positive financial release from the company. If that happens right at the same time, that would be the time to take a position in this company. So what are your thoughts on Limeade? Is it great value, or is it a value trap? Leave any thoughts in the comment section of this video. Last thing I should mention is I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is experienced and can speak to your own financial needs. That's it for this video. Have a good day. Bye.